Hi there, welcome to David's Investment Analysis channel. Today I'm very excited to be talking about a business that's very important in today's world, from the use of apps to video streaming or even just simply browsing. They ensure that the digital experience is fast and secure. And the company I'm talking about today is FSLY. The stock of FSLY went up over 108% in the last 3 months, over 233% in the last 6 months, and 256% since it IPO'd in April 2019. In the next bit, I'll be discussing about FSLY, what they do, and how they earn income. Then I'll look at the qualitative aspects of their business, followed by the quantitative analysis looking at the financials and valuation. Then I'll conclude on whether I think the stock is a buy at its current price and whether I own any shares of the business myself. I do spend a lot of time on preparing for these videos, so I really appreciate if you could share and like my video. And when I do reach 2,000 subscribers, I will be releasing a video on my top 7 individual stock holdings in my portfolio. So if you do not want to miss out on that, please do subscribe and click the bell notification. And if there's any other companies you would like me to cover in the future, please do leave in the comments below. Now let's get to it. So FSLY. FSLY operates an edge cloud platform for processing, serving, and securing its customers' applications. The edge cloud is a category of infrastructure as a service that enables developers to build, secure, and deliver digital experience at the edge of the internet. It is a programmable platform designed for the web and application delivery. As of June 30th, 2020, the company's edge network spans 100 terabyte software-centric network in 72 points of presence across 55 markets worldwide. It serves customers operating in digital publishing, media and entertainment, technology, online retail, travel and hospitality, and financial technology services industries. For those that are unsure of what edge computing is, it is the idea of placing computing resources closer to the user or the device at the edge of the network, like what you see here in the lower half of the diagram. Rather than a hyperscale cloud data center that might be miles away in the core of the network, like what you see at the top half of this diagram. The edge approach emphasizes reducing the latency and providing more processing of data close to the source. Not only that, edge computing enables developers to deliver a modern digital experience while simultaneously providing scale, security, and performance. Edge computing provides the developer end-to-end control versus the legacy where the developers only have control where the servers are. This is particularly important because developers are reinventing the way we live, work, and play online, and are the key to delivering user digital experience. FSLY was founded in 2011 and is headquartered in San Francisco, California. Now let's look at the qualitative factors, and we'll start with the management team. Joshua Bixby has served as the CEO since February 2020 and served as the president from May 2017 to February 2020. He has been an executive leadership team at FSLY since December 2015 and served in the part-time advisory role since 2013. Mr. Bixby served as the president and co-founder of Strange Loop Networks, a web application acceleration solutions company, from June 2006 until its acquisition by Radware in February 2013. From October 2002 to April 2006, Mr. Bixby was a co-founder, president, and chief executive officer of Iron Point Technology, Inc., a content management software solutions company. Mr. Bixby is the founder of Stanley Park Ventures, an early-stage foundry based in Vancouver, British Columbia. Mr. Bixby earned a BA in Management and Business Economics from the University of Toronto. It certainly appears that Mr. Bixby has a lot of entrepreneurial experience with several companies he founded and led. Arthur Bergman has served as the Chief Architect and Executive Chairperson and Chairperson of the Board of Directors since February 2020. He served as the CEO from FSLY founding in March 2011 until February 2020. From September 2007 to June 2011, Mr. Bergman served as the Manager, Vice President, and Chief Technology Officer of Wikia Inc., a global community knowledge-sharing platform. From November 2005 to March 2007, Mr. Bergman served as the Engineering Manager of 6 Apart, a social networking service. From the second half of 2003 to August 2005, Mr. Bergman served as the Engineering Manager of Fortango Limited, a subsidiary of Canon Europe. It also appears here that Mr. Bergman has a lot of developer experience. In February 2020, it was announced that FSLY CEO Arthur Bergman is stepping down. He said, "At my core, I am a developer. While I will always cherish the time I have spent leading FSLY, my true strengths and passion lies in building the architect and innovation, including our compute platform. I like being in the trenches, solving the most complex problems for our customers, and ultimately providing them with a better experience at the edge." In the same article, it said the company has struggled to meet its expectations in the year since the IPO'd, and growth has plateaued in the recent months. Since that time, the company's stock rose over 200% because of the high demand for their platform. I don't mind the stepping down of previous CEO to focus on what he's good at and what he enjoys as a developer, and let Joshua Bixby, who is more experienced in running and leading companies, to lead Fastly. Mr. Bixby is a new CEO, so we'll have to see how he does in the future. But the stock did go up over 200% since he took over as CEO. So I would continue to trust this management team and see where they would lead Fastly. Let's look at the industry outlook. There has been several research reports that suggest the edge computing industry would be growing in the next several years. Looking at this one from Allied Market Research, the edge computing market size was valued at $1.734 billion in 2017 and is projected to reach $16.557 billion by 2025, growing at a compound annual growth rate of 32.8% from 2018 to 2025. Factors such as an increase in load on the cloud infrastructure globally and rise in the number of intelligent applications are the major factors driving the growth of the global edge computing market. Edge computing assists real-time applications in analyzing and processing collectible data, which is also one of the crucial factors that drives the market demand. Furthermore, advent of the 5G network and numerous frameworks and languages for the Internet of Things solutions are expected to provide major opportunities for the market growth in the coming years. Let's look at another report. This one by Markets and Markets. They project that the global edge computing market to grow from $3.6 billion in 2020 to $15.7 billion by 2025 at a compound annual growth rate of 34.1% during the forecasted period. Factors such as growing adoption of Internet of Things across industries, rising demand for low latency processing in real time, automated decision-making solutions, and a need for surmounting exponentially increasing data volumes and network traffic. Moreover, the emergence of autonomous vehicles and connected car infrastructure and the need for light-weighted frameworks and systems to enhance the efficiency of edge computing solutions are expected to create ample opportunities for edge computing vendors. And this last one by Grand View Research, it suggested the global edge computing market was valued at $3.5 billion in 2019 and is expected to register a compound annual growth rate exceeding 37% from 2020 to 2027. Internet of Things Edge Partnership is expected to revolutionize data computing and account for various corporate gains for those that are looking to leverage and harness on the power of data analytics in developing solutions for major industry verticals. Moreover, to cope with the challenges of network latency and the need for immediate real-time insights has led to the evolution of multi-locational hybrid data architectures that store data locally at the edge. Furthermore, surging enterprise demand for more powerful computing at the edge has resulted in companies to offer AI-enabled edge solutions. We can see from these three reports that the compound annual growth rate is between 32% and 37% annually, which is quite high, and Fastly can definitely stand to benefit from this macro trend. Let's look at what the management says about the market. Fastly believes that 56% of the companies describe their digital transformation is underway. 75% of applications will be built and not be bought. 75% of data will be created and processed by the network edge by 2022, and 90% of the companies will be multi-cloud by 2021. All these suggest that the growing industry and opportunity for edge computing. Fastly intends to position itself to capture not only the app services and secure at the edge, but also content delivery networks and streaming sectors. So how does Fastly win customers? Within the legacy content delivery networks, the customers have chosen Fastly because of visibility, agility, and control, cost efficiency, modern developer-friendly architecture, reliable technical customer support, and better performance. With centralized cloud, customers have chosen Fastly because of instant scaling, cloud-agnostic, reusable modules at the edge, and better performance. And within the small focused content delivery networks, customers have chosen Fastly because of enterprise-grade features and programmability, reliable technical customer support, good neighborhood and clean activity, and better performance. And Fastly concentrates on these four competitive differentiators: programmable edge, software-defined modern network, safety and depth, and customer empowerment philosophy. And this has led to some significant wins, and here are some of the customers and partners. And some notable ones include Microsoft and Google as its partner, and Shopify, Slack, the New York Times, Pinterest, Reddit, Etsy, TED as its customers. So how does Fastly plan to continue to grow? Fastly has the following four growth initiatives. 1. Land and expand. Continue vertical penetration into enterprises that increasingly build their own software. 2. Platform expansion. Continue innovation with a focus on solutions and modules for verticals. creating the next generation developer tools such as the compute at edge and security. 3. Leverage partnerships, expand distribution footprint and technology ecosystem. 4. International and vertical expansion, grow revenue outside of US and penetrate new verticals. Let's look at some of the risks. Some of the factors that may hinder the growth of the global edge computing industry include the reduced in spending as a result of the decrease in business as a result of the global health issue, more local hardware increasing complexity of systems, and higher maintenance costs. Another risk is that Fastly has incurred losses since inception and may continue to incur loss into the future and may not be able to achieve or maintain profitability. This may lower investor confidence in the company. The success of Fastly's business is dependent upon their ability to adapt and respond effectively to rapidly changing technology, evolving industry standards, changing regulations, and changing customer needs, requirements, or preferences. If this is failed, the products will be less competitive, and this may lead to the inability to attract new customers or existing customers decrease their use of their platform or even leaving their platform. Fastly faced intense competition and could lose market share to competitors, which could adversely affect their business, financial condition, and results of operations. The competitors include Akamai, Level 3, Limelight, Cloudflare, Imperva, StackPath, Amazon's CloudFront, Google Cloud Platform, Citrix, Cisco, to just name a few. The loss of significant customers may have a material adverse impact on Fastly. Fastly depends on a small number of customers for a substantial portion of their business, and it is expected that the small number of customers will continue to account for a significant part of their revenue. And if one of their key customers decide to stop purchasing their products, it can materially reduce its demand and adversely impact their business. A great example of this is TikTok. On August 6 of 2020, President Trump issued an executive order banning transactions with ByteDance, effective 45 days after the execution of the order. This may lead to Fastly not being able to do business with ByteDance, the operator of TikTok application. And per Fastly's most recent quarterly financial statements, ByteDance is their largest customer, which accounts for 13% and 12% of the revenue for the 3 and 6 months ended June 30th, 2020 respectively. And this can be a huge hit for Fastly, and this is also one of the reasons why you saw the stock price plunge in recent weeks. Even at that, it is still up over 108% in the last 3 months. Now let's look at the quantitative analysis. Here are some of the numbers at a high level. I'll go into the details in the next bit on some of these numbers. Here is an example of Fastly's business model. To land in the first year, which is the initial deployment, then adopt, which is the digital transformation, and lastly expand, which is the edge compute and security. This would lead to a boost in customer usage and spend over time by offering increasing valuable products and services. This led to the dollar-based net expansion rate of 138%. This is additional revenue through expansion and cross-selling additional products or services to existing subscription customers, meaning on average a customer has purchased additional products or services from Fastly. And this is with a 99.3% annual revenue retention rate, suggesting that the customers really like their products and continue to keep Fastly as their preferred choice. Enterprise customers, which is the customer with the last 12 months of revenue in excess of 100,000, has increased to 304, 88% of the total revenue, and an average spend per enterprise customer of $716,000 for the period ended June 30th, 2020. And we can see here great revenue growth for the last few years, increasing from $104.9 million in 2017 to $144.6 million in 2018 and $200.5 million in 2019, representing a growth rate of 38% and 39% respectively. This also represents a compound annual growth rate of 45% in the last few years. Fastly is growing faster than the industry, which is very positive. In addition to growing revenue, Fastly has been able to improve on gross margins, increasing from 55.6% a year ago to 61.7% in Q2 of 2020. This is because of the inherent network efficiency similar to a vicious cycle. The more customers leads to more volume, leads to more security insights, connectivity, and data, which leads to lower costs and higher quality. With a decrease in capital expenditure as a percentage of revenue would generally lead to a better free cash flow. And this is what we see here, and is driven by CapEx efficiency. I'm happy to see that the sales and marketing and research and development both decreasing as a percentage of revenue, which is what is suggesting that the revenues are increasing faster than the expenses. The general administrative expense increased because of additional expense associated with the IPO. So let's hope that this is true and hope to see that the general administrative expense as a percentage of revenue would decrease going forward. Let's look at the Q2 highlights. I've already discussed about some of them already, so I'll just mention a few that I have not yet discussed. So the total customer count increased to 1,951, up from 1,837 in Q1 2020, the largest quarterly growth since IPO. GAAP operating loss of $14 million compared to GAAP operating loss of $12 million for Q2 2019. Non-GAAP operating income of $2 million, up from non-GAAP operating loss of $9 million in Q2 of 2019. The larger loss in the quarter is mainly due to stock-based compensation. The non-GAAP operating income adjusted for this stock-based compensation, and it's very positive to see a positive non-GAAP operating income. GAAP basic and diluted net loss per share of 14 cents, up from GAAP basic and diluted net loss per share of 26 cents in Q2 of 2019. Non-GAAP basic and diluted income per share of 2 cents, up from non-GAAP basic and diluted net loss per share of 16 cents in Q2 of 2019. Adjusted EBITDA of $7 million, up from a loss of $6 million for Q2 2019. This is the first positive quarter, so things are looking great for Fastly. They also raised the full year 2020 guidance. We'll look into that right after we look at the balance sheet. So looking at the balance sheet, Fastly has $257 million of cash and cash equivalents, $126 million of marketable securities, and $70 million of restricted cash. The restricted cash is held as a cash collateral in connection with their cash collateral revolving credit agreement. Fastly has limited debt and a total liabilities of $65 million. Fastly has sufficient cash to cover total liabilities, so it suggests that the balance sheet is very strong. So where did the cash come from? Since December 31st, 2019, their cash was only at $16 million. We can see here a huge increase in the pay-up capital, so it suggests it's likely an equity financing was done. Let's look at the cash flow statement to see if that is true. So we can see here indeed that the majority of the increase in cash is because of the issuance of shares that was done during the quarter. One of the concerns I do have is the cash from operation, which is an outflow of $8.7 million cash. I generally like businesses that have positive operating cash flows. Let's look at the management's guidance. They have increased their guidance for the full year 2020. I don't believe this includes the possibility of the impact of losing ByteDance, which is approximately 12 to 13% of Fastly's total revenue. Management expects $290 to $300 million of revenue in 2020 year, an increase from $280 to $290 million. They also expect a loss of $2 to $12 million, better than the previous projected loss of $10 to $20 million, and loss per share of 2 cents to 6 cents, better than the previous projected loss of 8 cents and 15 cents. These projections are in line with analyst expectations. Let's look at some of the valuations compared to the competitors. I've included Amazon because they do have edge computing Amazon's cloud front, but it is a very diverse business. The market cap of Amazon is $1.6 trillion, Cisco is $179 billion, Akamai is $17.5 billion, Limelight is $731 million, Cloudflare is $11.7 billion, and Fastly is at $8 billion. Looking at the current price to earnings ratio, Fastly appears to be expensive because they do not have any positive earnings, although they are getting very close with that. Looking at the price to sales ratio, it looks very expensive, but also it is projected to grow the fastest amongst the group. So looking at the price to sales to growth is trading reasonable compared to the group. But please do note that the projected sales did not include the potential loss in sales from ByteDance. Fastly also has a reasonable amount of cash on its balance sheet and should be sufficient for some time after it did equity financing during the previous quarter. Hopefully it's sufficient until Fastly is cash flow positive. Looking at the stock price is up over 108% in the last 3 months, over 233% in the last 6 months, and 256% since the IPO in April 2019. So the stock price increase has been pretty impressive. Looking at analyst recommendations, it has not been updated for August 2020, but looking at July, there are 4 strong buys, 1 buy, 3 hold, 1 underperform, and 1 sell, with an average rating of a buy and a price target between $58 and $107, with an average of $93.25. The price of the share currently sits at $76.61. And within the last month and a half, we can see Arthur Bergman and Joshua Bixby selling a lot of their shares, especially Arthur, where one of the days he sold $43.4 million worth of shares. Seeing management selling their shares is a concern for me because, generally speaking, management probably knows their business the most, and when they sell, it's likely they think that it's overpriced, or else why would they sell their shares? Conclusion. In my opinion, at today's price of $76.61, I think it's a speculative buy or a hold because of the following reasons. They have a strong management team led by CEO Joshua Bixby appears to be a successful entrepreneur and is working with a very experienced and knowledgeable management team. Fastly has some amazing projections and is set to grow faster than industry's 32% to 37% compound annual growth rate, suggesting it will be taking market share from other competitors. Fastly is partnering with some of the largest companies in the world and have successfully won contracts with some of the large organizations such as Shopify, Slack, the New York Times, Pinterest, Reddit, just to name a few. Fastly has several growth initiatives that include continuous vertical penetration into enterprises, introducing new modules on their platform, leveraging partnerships, and international vertical expansion. Fastly has an amazing dollar-based expansion rate of 138% and an annual revenue retention rate of 99.3%, suggesting that the customer are using more of their service and continue to stick with Fastly for their services. In addition to this, they've been able to increase the gross margins. Fastly has a strong balance sheet providing flexibility to make acquisitions and grow a company organically in the future. But I do have some concerns, and here are some of them. Some of the factors that may hinder the growth of the global edge computing industry include the reduce in spending as a result of the decrease in business as a result of the global health issue. More local hardware are increasing the complexity of the systems and higher maintenance costs. The growth potential does look very promising for Fastly, but remind you that these projections are only estimates and can be very different from reality, especially the possibility of losing ByteDance, which accounts for 12 to 13% of Fastly's revenue. This is particularly concerning because noted in their financial statements that Fastly depends on a small number of customers for a substantial portion of their business, and it is expected that the small number of customers will continue to account for a significant part of their revenue. And if one of their key customers decide to stop purchasing their product or services, it can materially reduce the demand and adversely impact their business like ByteDance. Fastly has incurred losses since inception and may continue to incur losses into the future and may not be able to achieve or maintain profitability. This may lower investor confidence in the company. The success of Fastly's business is dependent upon their ability to adapt and respond effectively to changing technology, evolving industry standards, changing regulations, and changing customer needs, requirements, or preferences. If this is failed, the products will be less competitive and may lead to the inability to attract new customers, or even existing customers decrease their use of the platform or even leaving their platform. Fastly face intense competition and could lose market share to competitors, which will adversely affect their business, financial condition, and results of operations. Their competitors include Akamai, Level 3, Limelight, Cloudflare, Imperva, StackPath, Amazon's CloudFront, Google Cloud Platform, Citrix, Cisco, just to name a few. And they are also trading at a pretty expensive valuation at 27 times 2021 sales and 20 times price to 2022 sales, even with the incredible growth rate of 40+%. Disclosure: I currently do not own any shares of Fastly, and I do not intend on buying any shares in the near term, just because it's a bit too speculative for me. Although I think it's a great company, but I do see some headwinds coming its way, such as the possibility of losing ByteDance as its largest customer. And not only that, but the valuation, it's a bit too rich for me. So unless it comes down significantly, I likely wouldn't be buying any shares at this price. That's it for now. I spent a lot of time preparing for these videos, so I really appreciate if you could like and share my video. And when I do reach 2,000 subscribers, I will be releasing a video on my top 7 individual stock holdings and my portfolio. So if you do not want to miss out on that, please do subscribe and click the bell notification. Thank you for watching. Until then, see you next time.